Good morning. Okay, I think we're gonna get started here. Good morning, and thank you for joining us for today's web seminar. I'm Karen Weisskopf, Vice President of Marketing at First Island Investors. First and foremost, we hope everyone had a great summer and continues to be healthy and doing well. We have a great agenda planned for today's session. I'm joined this morning by some key members of our investment committee. They include Robert D. Rosenthal, our Chairman, CEO, and Chief Investment Officer, Edward Pileski, SVP of Wealth Management, Brian Gamble, VP of Wealth Management. Additionally, other members of the investment committee and wealth management teams are on hand and available to answer any questions. Before I hand it over to Bob, I'm going to cover a few logistical items. All participants are currently in listen-only mode. After the team delivers the presentation, we will have time to answer any questions submitted throughout the presentation, as well as some we received in advance. Please feel free to submit questions as we go through by using the dialog box labeled questions. At this point, everyone should see a slide with the heading Today's Speakers. If you're not seeing that, please let us know by typing something in the chat window, and we'll do our best to troubleshoot. And finally, our General Counsel always asks that I remind you that today's session may discuss the performance of some strategies, and that past performance is not a guarantee of future results. In addition, given today's topics, it's important to note that anything discussed on this call should also not be considered medical advice. With that, I'm now going to hand it over to Bob.
Thank you, Karen. Good morning, everyone, and thanks for joining our webinar. Our agenda this morning is to cover briefly COVID-19 pandemic and its impact on the U.S. economy, followed by a market overview, and then looking ahead, particularly in this complex environment that we're facing, the FLI investment approach in this complex environment, a summary, and then a Q&A period. Next slide, please. The quote that we used this past quarter really depicts where we are and what to expect. And let me read the quote. People who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Calamitous drops do not scare them out of the game. And that's a quote from the famous investor, long-term investor, Peter Lynch. Obviously, we had an unexpected occurrence that we're still going through, and that is the COVID-19. We had a calamitous drop of near 35% in a very short period of time. But we advised our clients to stay the course, and we've rebounded significantly, which we'll get into. But this quote is quite appropriate for what we have been going through and what can happen in the future. Next slide, please. This slide depicts where we are at this point in the COVID-19 pandemic. And as you can see, it's as of 9/15/20. The United States has approximately 6.5 million confirmed cases of COVID-19, and unfortunately, confirmed fatalities of almost 195,000. Globally, this pandemic has impacted roughly 188 countries with over 29 million confirmed cases and over 900,000 confirmed deaths. If you look at the chart on the left, or the graph on the left, daily COVID cases and deaths, it's very interesting. As you can see, when this horrible, heinous virus attacked us in March, it peaked initially in the month of April, with the New York metropolitan area being the epicenter of the virus. And as it turns out, the health system that I'm a trustee of was at the epicenter of the virus and actually treated more than 70,000 COVID patients, making it the health system that treated the most COVID patients in the country. The good news is and was, as you can see from the blue and red line, they both declined. declined rather rapidly, so that by June 7th, as you can see on the chart, we were at a lower point. And then the heinous virus attacked in some southern and western states, and the new cases on a daily basis spiked up to almost 70,000, and deaths actually went up, but not quite as much percentage-wise as the new cases. And perhaps that's because of much more testing that was done and a better technique to treat COVID-19 patients. The prospects for the fall and winter are of concern. The public must adhere to wearing masks, washing hands, and being socially distanced. If we do that, medical experts believe we will mitigate a potential rise in COVID-19 again. There is a concern amongst medical professionals that being that we're going into the regular flu season, the confluence of both COVID and regular flu can create issues. There is, though, some good news, and that is doctors believe that if people do wear masks and do adhere to washing their hands and being socially distanced, the incidence of regular flu should be less. On the good news front, there's advancement and development of new and additional therapeutics for the treatment of COVID. Initially, it was thought the go-to device to use for someone with COVID was the ventilator, and the country made great efforts to produce a massive amount of ventilators. It was then determined by doctors, or most doctors, that using a vent was not the best course of treatment. Using steroids and other conventional products was more advisable. And a company called Gilead developed something called remdesivir, which has lessened the severity. So there are some new and additional therapeutics that are coming to treat COVID if you have it, which should keep the fatality rate low. But the really good news is the prospects for vaccines. There are three major companies led by Pfizer in phase 3 testing. The other two are AstraZeneca and Moderna. And just behind them is Johnson & Johnson that will enter phase 3 testing shortly. And if you're not familiar with the phases, just lost my screen here, excuse me one second. If you're not familiar with the phases, the phase 3 is a testing of a massive number of people, and it's about 30,000. Just bear with me for 1 second as I have lost my screen. Karen, having a little bit of a technical issue here. Wait 1 second. Please bear with me. No. Well, I'll have to go by ear here. Wait. I apologize. My computer screen has lost the presentation. Please bear with me.
Everyone hold on for 1 second.
I am connected to the seminar, but unfortunately I don't have the screen. I apologize. Bear with me for 1 moment. I'm having a technical glitch here. Let's try this. No. Just hold on 1 second. I'm going to use a different device. While I connect to the different device, the phase 3 testing, which is critical, 30,000 patients for each of the large pharma companies. Oh, here we go. Okay.
I got you, Bob. You should be good.
So phase 3 testing is each of the major companies that I mentioned are using 30,000 diverse patients from different geographies to test the efficacy and safety of the drug. The really good news is that the federal government stepped up with these companies and others to invest in the mass production of the drug or the vaccine prior to approval. The country is spending hundreds of millions of dollars to do this in the hope that one of these or two of these vaccines will prove to be efficacious. And once approval is given, instead of then having to wait months and months for the mass production of the doses of the vaccine, the vaccine will already be available for distribution. Also on the good news front, and just an indication of perhaps some optimism, my health system, which consists of 23 hospitals, sent me an email this morning saying that they were already organizing the methods to be used to distribute and give patient doses of a vaccine once it's approved. So they're gearing up amongst the 23 hospitals and some 600 ambulatory sites to be prepared to take patients and give them the vaccine when it becomes available. And they believe it's quite possible some of this will be done before the end of the year. So that's very good news. So although we still have COVID and we have to deal with it, we are, I think, in a position where we'll mitigate the severity of it using the therapeutics that are available. And the prospects for a vaccine should give us some confidence going into next year. Next slide, please. But the economy has taken a hit. And as you can see, this slide goes back a number of years to show the growth or the negative growth of real gross domestic product. And as you can see, in 2020, we took a tremendous hit where GDP was a negative almost 10%. If we use as a reference point the Great Recession of 2008 and 9, their GDP dropped by about 4%. So this was a much more severe decline in gross domestic product, but it was obvious it was caused by a government shutdown. It wasn't caused by other factors. We, the government, closed down the economy, which led to this precipitous drop. The green line projects what the growth rate will be, in our opinion, going forward. And as you can see, it ramps up significantly in the third quarter, continues to grow in the fourth quarter and into next year, although at a slower level, but much above the trend line of average GDP growth, which is somewhat above 2%. Next slide, please. Another important aspect to look at is unemployment. As you can see, we hit a high of about 15% unemployment in the first quarter of this year going into the second quarter as the impact of the shutdown was most egregious. The good news is, as you can see, from near 15% unemployment, we've dropped to 8.4% unemployment. If you go back to the recession of 2008 and 9, unemployment peaked at about 10%. So the severity of this decline was much greater, but the ability to come back from it has also been very quick. So we've gone from minus 15 to 8.4% unemployment. So there is hope. We're making improvements to the economy, and the employment picture is dramatically improving. But as you can see, we have a ways to go. Just prior to the COVID epidemic or pandemic, unemployment was about 3.5%, which was the lowest unemployment rate in more than 50 years. So we've got a long way to go to get back to that, but we're well on our way. Next slide, please. Business confidence is depressed. I mean, there are two major components to the economy. One is business, and the other is the consumer. So we'll deal with business first. If you look at the graph on the left, real private, non-residential fixed investment, this shows the temperature of business to invest. Are they investing a lot, or are they investing a little? And as you can see, investment actually went down by almost 10% during the pandemic. And that's because businesses were shut down, so obviously they weren't spending. If you go back to the recession of 2008-9, you'll see that business investment declined even more. And our belief is that business investment has not dropped as much as that period of time because of the tremendous work by the Fed and the federal government to infuse money into the system, which also will lead to some sort of confidence both in business and in the consumer. And that's reflected in the slide on the right. As you can see there, small business optimism dropped precipitously, but again, not nearly as much as it dropped in the 2008-9 period. And again, we believe it's because the government and the Federal Reserve acted quickly, acted bluntly, and acted with a great deal of passion in terms of getting the economy back. So the amount of resources, and we'll discuss more of this later in a later presentation, the amount of resources used by the Fed and by the federal government was significantly more during the pandemic than it was during the recession of 2008 and 9. As you can see, again on the slide on the right, confidence is beginning to come back in business. That ultimately will lead to real private, non-residential fixed investment. Next slide, please. Now, the other side of the coin is the consumer, which makes up about 70% of the economy. And as you can see on the slide on the left, U.S. Conference Board consumer confidence, we were at a very high level prior to the pandemic, and then we dropped significantly. But again, consumer confidence did not drop as much during the pandemic as it did during the recession of 2008 and 9. And again, we attribute that to the actions of the Federal Reserve and the federal government working in a bipartisan way to support the economy, to mail checks out to consumers, to provide the PPP program, which helped businesses. So that although consumer confidence did drop, as you can see, it did not drop nearly as much as the 08-09 period, and it's starting to stabilize. The chart to the right is also very interesting. When people are afraid and they're concerned about their economy, they save more. So the savings rate, which typically had averaged about 5.5, maybe 6%, as you can see in prior years, it jumped, to almost 35%. However, more recently, it has dropped back down to below 20%, which is an indication that the consumer is beginning to spend. We actually call that economic velocity, because if there's a lot of money infused into the system, or consumers have a lot of money, those that are still working, but they're not spending, there's a lack of velocity. When they start to spend, we have velocity. And velocity is key to getting the gross domestic product to grow. It's key to getting consumer sales to grow, and we'll see that on the next slide. But the good news here is that, yes, people started to save a lot, and now they're saving less as they spend more because confidence is getting better. Next slide, please. Again, looking at the consumer, which makes up the majority of the domestic economy, the chart on the left, single-family new homes sold, shows you that during the recession of 2008-9, things dropped precipitously in terms of new homes sold. Here during the pandemic, they dropped, but they've rebounded significantly. And one of the major reasons for this is interest rates are near zero, so mortgage rates are very attractive. So as consumer confidence starts to grow, people become employed again, which is happening. They're out looking for homes. Also, the fact is that there are certain real estate sections of the country are being impacted in major cities where there are some disruptions that we'll talk about later. People are moving out and looking for homes. But the good news is single-family new homes sold is rising. That's very good for the economy. It also shows the level of consumer confidence. The chart to the right, which is lightweight vehicle sales, is also another indication of how the consumer is feeling. Again, if you go back to 08-09, which was the recession, you saw a precipitous drop in lightweight vehicle sales. If you look at the pandemic, which occurred in the last several months and is continuing, you'll see a significant drop, but then a snapback, which again shows that confidence is building in the consumer and they're spending and they're optimistic that the government will continue to support the economy until it gets back on its own. Next slide, please. Now, this is a confusing chart if you look at it. I'll try and make it less confusing or simplify it. But again, this goes to spending patterns of the consumer. It shows you the volatility in spending and what happened during the height of the pandemic, at least what we hope was the height of the pandemic. Purchase mortgage applications dropped by 35%. They're currently growing by over 20%. Retail sales dropped by 10% and now increasing by 5%. Consumer debit credit transactions dropped by 33%, and they're still negative 6%, but obviously they're rebounding. Auto sales, as we saw, dropped by 47%, and currently they're only down by 11%. Again, a significant factor. Public transit demand, people afraid to go on subways and trains and airplanes, dropped by 72%. Now they're only down by 55%. So again, shows an improvement. U.S. seated dinners. Who could go to a restaurant? Well, during the maximum close down, we were down 100%. Now, as the economy is starting to open up, and even New York City, I believe next week, is permitting in-house dining up to 25% of capacity, we've rebounded to minus 55%. Still a long way to go, but a definite trend of improvement and evolution of the economy in terms of its improvement. U.S. seated diners down 100%, now only down 60%. And last but not least, the TSA traveler, those who go to the airports or the train stations, down 96% at the peak of the pandemic, now down 60 some odd percent. So the story with this chart is we're still coming through the economic hit to the economy, but we are making improvements. We are evolving, we are growing. Now, whether you want to call this a V-shaped recovery, or I've heard a square root-shaped recovery, or I've heard a K-shaped recovery, we're not sure. But we believe there is a robust growing economy at this point. It's probably not quite a V, but we're certainly making improvements, and that's something that we all should feel very good about, as long as we maintain wearing our masks and we wait for a vaccine and we socially distance and we wash our hands so that we don't have a spike of the pandemic again. And with that, I will turn it over to my partner, Ed, to talk about where the markets are.
Thank you, Bob. And thank you, everyone, for joining us today. Equity markets are indeed climbing higher. As you can see, the total return performance of the three benchmarks here, the NASDAQ, the S&P, and the Dow, have all rebounded nicely since March 23rd. You can see the NASDAQ's up 59%, the S&P is up 51%, and the Dow's up 49%. So these, prior to those upswings on March 23rd, these benchmarks declined significantly within the 6-week period in parts of February and March. It was one of the fastest ever falls from record levels into a bad market as the economy shut down and the coronavirus spread across the globe. Since then, U.S. stocks have been on a rebound that's unprecedented in the modern era of financial markets. This year's market recovery is even more remarkable given the coronavirus pandemic's impact on the global economy, as millions remain unemployed. Corporate profits have experienced steep declines, while the pandemic has yet to be fully contained. So I think it's worth now discussing what's driving this historic rally and kind of explaining where's the disconnect here. Next slide. So in explaining the disconnect, I think we should first focus on the significant federal stimulus. That's certainly been a key factor in the response of the Federal Reserve, which has moved earlier and I would say more aggressively than ever before. Federal Reserve Chairman Powell led the central bank to move faster in the weeks after the financial markets seized up, as it outlined plans to lend billions of dollars across markets, purchase large quantities of government debt, and lent millions and millions of dollars to American businesses to stabilize the economy. The other factor would be the record low interest rates. The Federal Reserve also cut interest rates to near zero due to the Fed's intervention It bought corporate and treasury bonds. Yields then tumbled, making stocks even more attractive. The real yield on treasuries slipped to negative levels as bond prices rallied, meaning investors who parked their money in government bonds could expect to lose money when adjusted for inflation. The dwindling returns pushed investors into stocks. There you have the abbreviation of there is no alternative, TINA. So that existed where there were a few other attractive options, making equities certainly from a return perspective and a yield perspective a good place to be. I think the other focus or the other key factor we should talk about are the market drivers and the pandemic winners and explaining the disconnect. The global equity markets have recovered before the economy has recovered completely. So underpinning the stock rally is the realization or belief that the coronavirus will ultimately be managed through treatment and vaccines, which should lead to a normalization of economic activity over time. Manufacturing activity accelerated in August. Hiring has increased for 4 straight months, and consumer spending has picked up. Meanwhile, private sector economists expect annual gross domestic product to bounce back next year. So there is optimism. There are market drivers along those lines that has led to an upswing in the market of late. Also, the pandemic winners. The gap between the stock market's winners and losers is stark and growing. Certain companies have thrived in this environment, having benefited from societal changes forced by the pandemic, and are increasingly influential in the market. Many of these companies possess products or services and thrive on or capitalize on secular growth trends, which accelerated because of the pandemic and benefited from these shifts towards the new or revised ways of life for both businesses and consumers, such as continuing to work from home, shopping online, or streaming movies online, as well as digital payments. So companies like Apple, Amazon, Microsoft, Alphabet, and Facebook were the true pandemic winners in that sense. Next slide. So really, it's remarkable the government actions to offset the impact of the COVID-19 recession. You could see here the response, whether it was the Federal Reserve, the legislative branch, or the administrative branch, in terms of the trillions of dollars that were ultimately allowed. And you could see that some have been committed, and there's room for more assistance if needed. So the fiscal policymakers and the Federal Reserve have responded to the economic impacts of the pandemic with unprecedented actions, providing trillions of dollars of stimulus for the economy and the financial system. The U.S. government has sent more than 150 million stimulus checks to Americans and backed around $500 billion in loans to small businesses. The trillions of dollars of the Fed and the fiscal stimulus allowed will provide a meaningful safety net if more is needed to be dispersed to ensure the impact of the COVID recession is offset. Next slide, please. And as for monetary policy, you could certainly see that the Federal Reserve has made it clear that the monetary policy will remain accommodative for an extended period. The Federal Reserve utilized its tools to control and increase the money supply in order to stabilize the economy. In 2020, you could see that spike up where there was a significant increase in the money supply during the pandemic. The increase reflected the tough economic period and the Federal Reserve's actions to cut interest rates to near historic lows and increase the money supply to provide liquidity, stabilize the economy, and spur growth. Next slide, please. So this demonstrates the market expectations versus the Fed's forecast. And there was recently a quote by Jerome Powell, Fed chairman. And I think the key point here is that they're talking about inflation that runs below its desired level can lead to an unwelcome fall in long-term inflation expectations, which in turn can pull actual inflation even lower. So let me break that down. There's been a significant revamp of monetary policy. Recently, the Fed chairman Powell announced that the Fed is embracing a more flexible approach to setting short-term interest rates and how they go about doing it. Instead of raising rates preemptively in anticipation of higher inflation, the Fed will adopt a more patient and less forward-looking approach when deciding to raise policy rates. The Fed has become less fearful of inflation and will now exhibit a greater willingness to tolerate a higher rate of inflation. So the Fed is basically dropping its long-standing mandate to raise its policy rate when the annualized rate of inflation reaches, say, 2%. Instead, the Fed will now target an average inflation rate of 2% over time. So the Fed's new approach reflects its concerns for both deflation and a prolonged period of elevated unemployment. So now the Fed is willing to basically accept a higher rate of inflation as a solution for what it perceives as material risk to the economy resulting from the pandemic. Next slide, please. This is a very interesting chart. It shows the market drivers and the pandemic winners. It's the major contributors of S&P returns since that March 23rd date that we referenced earlier. As you can see, the top 10 companies total about 38% of the S&P gains since March 23rd, while the top 5 companies make up 24% of the S&P by weight, a 30% record. And you can see that Apple at around 11% and Amazon at 6.5 and Microsoft at 6.1 are the names that have really led the way back, if you will. These are a select group of stocks with, again, significant weightings in the S&P index. As you can see, they're concentrated in technology, communication, and media sectors, and obviously they perform very well. But what's interesting to note, while these names have performed quite well, the vast majority of stocks in the index have lagged pretty badly. Cap-weighted indexes like the S&P can be heavily influenced by a small group of stocks with very large market capitalizations. So the bottom line is the performance of the S&P has been significantly distorted by the dominance of a select group of large cap stocks that are beneficiaries of the coronavirus and have performed extremely well. And it's also worth noting that we here at FLI invest in the majority of these companies that you see on your screen here. Next slide, please. So let's look forward and talk about valuations. You can see here the purple line is the next 12 months for the S&P. It's the PE around on 920 was around 21.8. The blue chart is the 10-year U.S. yield as of September 20th was around 63 basis points. And you can see here as of September 20th, the next 12-month PE for the S&P is indeed above the PE average, which is around 15 times. So I think it's worth noting that although the S&P 500 next 12 months PE is around 21.8, the somewhat higher PE ratio can also be justified as compared to the 10-year Treasury yield around 63 basis points. You could see that equities still look relatively attractive. Although valuations are elevated over that PE average of 15.3, low rates are indeed supportive. As earnings begin to recover in 2001, and with interest rates remaining historically low, the market may well move higher in both price and valuation. So again, continuing on with looking forward for the next slide. You could see here with regard to the recession and recovery, we have the real U.S. real GDP from 2017. Obviously, there was an increasing trend here from 2017 to 2020. Obviously, that has turned around with a drastic turn for the worse in the early part of 2020 due to the effects of the coronavirus pandemic. GDP declined at a 5% pace in the first quarter and shrank at an annualized 32% in the second quarter. The third quarter GDP, although which you're starting to see in the green, it has an upward trend. The third quarter GDP report comes out on October 29th, and it's expected that the U.S. economy and the labor market are recovering from this coronavirus-related downturn. In a recent poll, the Wall Street Journal surveyed business and academic economists and their expectations for the third quarter. That came in, their expectations for the gross domestic product in the third quarter is to come in at an increased rate of 29.3, an annualized rate of 29.3 for the third quarter. So there are expectations of the GDP ultimately recovering and beyond 2021. Next slide, please. So I think it's important, certainly looking forward, political activity for the next 2 months is going to be on everyone's mind. The U.S. is experiencing 4 super disruptive events at the same time: the pandemic, recession, the protests, and obviously the presidential election. The potential change in the White House, the Senate, and possibly the House of Representatives is certainly going to be in play. Democrats have suggested that they would raise taxes on wealthier individuals through income tax and the state tax, so that is going to be a hot topic. Certainly Americans are more divided than in recent history on these key issues of racial inequality and wealth disparity, leading to peaceful and non-peaceful demonstrations across the country. And I think FOI, Personal Allowed Investors, has made an effort to kind of shed more light, provide more insights on these various topics. And we're going to be doing that on October 27th, where 1 week before the general election, Personal Allowed Investors will have a special online event with Dan Clifton, who's the head of policy research of Strategic Securities. Dan is a top Washington policy analyst and will share with all of us his take on the various electoral contests. So hopefully you could join us on that particular day, October 27th, and hopefully you'll find it very insightful. I will now turn it over to my colleague, Brian Gamble, who will talk about our investment approach. Brian?
Thanks, Ed. All right, Karen, next slide, please. All right, many of you have seen this slide before. This is our approach to asset allocation and our approach to wealth management. We view the investing world in 4 baskets. First is our security, which contains cash and high-quality fixed income. We have defensive strategies, which include hedged growth, dividend growth, and multi-strategy hedged investments. Next up is traditional equities, which contain diversified equities across growth and value, large, mid, small cap, domestic and international. And then our 4th basket contains more illiquid investments like real estate, private equity, real assets, and collectibles. So our approach to asset allocation has been pretty steady recently. We continue to maintain an underweight to fixed income with a focus on quality and short duration. We continue to overweight our defensive strategies, even more so given the current environment. We continue to recommend a modest underweight to traditional equities with a bias to growth and domestic, given the current valuations and economic conditions that Bob and Ed mentioned earlier. And then we continue to utilize private investments as opportunities arise and where we see appropriate. Obviously, this overall framework is customized and adjusted over time for each client and his or her individual needs and situation. Next slide, please. All right, as part of an overall asset allocation, we've been recommending that clients should have enough cash to sleep at night. Having cash on hand to cover expenses for a period of time can help weather turbulent markets. On the other hand, holding too much cash as a percentage of one's assets can hinder one's ability to achieve one's goals. The bars on this chart in gray show the interest earned on a $100,000 savings account over the past 25 plus years. With interest rates being at or near historic lows, it is not surprising to see that the interest earned has come down dramatically over this time frame. The blue dashes you see on the chart show the amount of interest earned needed to keep pace with inflation. As you can see, interest earned is well below the rate of inflation currently, and has been for quite some time. $100,000 of savings earns $240 of interest today for the year. In order to keep up with inflation, interest earned would need to be $1,566, while in order to keep up with education inflation, interest earned would need to be $2,168, and interest earned would need to be $5,024 to keep up with medical care inflation. Thus, in order to keep pace with inflation and not lose purchasing power, one must not hold too much cash while utilizing a prudent, customized asset allocation. Next slide, please. On the previous slide, we discussed the paltry rate of interest earned on cash and savings accounts. On this slide, we can see that the yields on fixed income instruments are not much better. The 5-year Treasury, 10-year Treasury, 5-year tax-free municipal, and investment-grade corporate bonds all yield well below the rate of inflation, both pre-tax and net of federal tax. These historically unattractive yields put investors in a difficult position, and for this reason, we remain underweight fixed income. In comparison, if you look at the two rightmost bars, you can see that the S&P 500 yields slightly less than the rate of inflation net of federal tax. However, our dividend growth strategy, which is part of the defensive basket from the earlier slide, yields well in excess of the rate of inflation, even net of federal tax. In addition, while the yields on fixed income instruments are fixed, we target 7 to 10% annual dividend growth from our dividend growth strategy. So far this year, our dividend growth strategy is averaging a 7% dividend increase, despite 3 companies not increasing their dividends. This compares favorably to the S&P 500, which at this point looks like it will have flat to slightly negative dividend growth this year, depending on how the rest of the year plays out. This supports our recommendation of an overweight to our defensive strategies. Next slide, please. Clients ask us all the time what we like in terms of investment areas. Within our equity-based defensive and traditional equity strategies, while we are not thematic investors, there are certain key trends that we are focused on. While many of the areas shown here have become more prominent since the pandemic started, these are areas we have been focused on for many years. First and foremost, we remain focused on high-quality companies with significant competitive advantages. The continued growth in online shopping is an important trend. The pandemic has only served to accelerate the rate of adoption for online shopping, with reports projecting it having accelerated by 5 years. Online sales are projected to grow by 20% in 2020 and accounted for 16% of retail sales in the second quarter of this year, up from 12% in the first quarter. Amazon.com, unsurprisingly, is a beneficiary of this trend, but more traditional retailers transitioning to an omni-channel presence, such as order online and pick up in store, are also benefiting. Example of that is Home Depot. Next, 5G technology has the potential to transform how we and our devices communicate. The Internet of Things will be a key driver as more and more devices connect to the Internet to share data and information. Qualcomm, which holds many patents for this technology, is poised to be a significant beneficiary. Cloud computing has changed the way we store data as we move to centralized, off-site storage. The recent pandemic has only served to accelerate this transition, with more and more companies moving to online storage and communication enterprise systems, with key beneficiaries being Amazon.com and Microsoft. The next area, social media, has changed the way we interact with each other and businesses. These platforms have given companies the ability to reach their specific target markets with online advertising and should continue to benefit from the increase in digital ad spending. One example of this would be Facebook. Up next, electronic payments is an important secular growth trend. The shift away from cash and check to a lot of electronic forms of payment have been going on for a while, and the pandemic has only served to accelerate those trends as people shop online more and want to handle cash less. Key companies here include Visa, MasterCard, and PayPal. Online search is very similar to social media in that companies are able to target specific demographics with advertising tailored to consumers. The continued adoption of digital advertising is key as companies use advertising spend more efficiently. One key beneficiary here is Alphabet, the parent company of Google. Pharmaceuticals and medical instruments are important areas for our economy. As our population continues to age, healthcare will become an even more important part of our lives. We look to companies such as Intuitive Surgical, Johnson & Johnson, and Amgen to continue to innovate and come up with treatments for ailments and diseases. With the onset of the pandemic, these companies have become even more important as the need for therapeutics and a vaccine became paramount. Last, but certainly not least, we focus on dividend growers. Our dividend growth strategy is predicated on owning companies that not only pay a dividend, but grow that dividend annually. It takes a strong balance sheet, consistent earnings growth, and a corporate culture and desire to be shareholder friendly. Examples include Fastenal, Texas Instruments, and McDonald's. Next slide, please. Within traditional equities, we continue to recommend maintaining a modest underweight to the overall space with a bias to growth in domestic companies. As you can see on the chart, growth has significantly outpaced value since December 31, 2007, comparing the darkest blue line to the lightest. Through both the Great Recession of 2008 and 9, as Bob coined it, and the most recent downturn earlier this year due to the pandemic. With a slow-growing economy, growth companies typically perform better than value companies, and given the uncertain nature of the recovery, we continue to recommend a growth bias while still maintaining an allocation to value as we continue to look for signs of a stronger recovery. Additionally, on the chart, you can see that domestic, the three blue lines up top, have dramatically outperformed international, the two green lines, over the same time frame. We continue to believe that a domestic bias is warranted given the policy initiatives taken by the federal government and better economic growth prospects domestically versus other developed markets, specifically Europe. Next slide, please. On this slide, we can see the money mountain, or the amount of cash on the sidelines. You can see on the chart that the amount of cash on the sidelines has spiked to record levels this year due to concerns over the pandemic and has only started to come down slightly. This large money mountain on the sidelines continues to earn next to nothing in cash, and Treasury bond yields are at or near historic lows, as we discussed earlier. This suggests to us that some of these funds will seek asset classes with better returns in the near future, including equities. We take this as a positive contrarian indicator. And with that, I'll hand it back over to Bob for our summary.
Thanks, Brian, and thank you, Ed. COVID-19 is a terrible, devastating illness that has had a health and financial impact on the entire world. The medical and pharmaceutical fields, with the support of the federal government, and I want to emphasize the support of the government, which has been incredibly helpful in terms of financing the development of vaccines and therapeutics, are voraciously working to develop vaccines and therapeutics as well as enhance testing protocols. And by the way, the testing is getting better and better. One of the companies that we invest in has perfected a very quick test, a very inexpensive test, and millions of these tests are going to be distributed shortly. That's Abbott Labs. The U.S. equity markets are seeing record levels, and prior to the crisis, the U.S. economy was strong, which bodes well for the recovery. Keep in mind that our unemployment was at the lowest level in 50 years. We had significant GDP growth. Consumer confidence and business confidence was quite high prior to the pandemic. So the self-imposed shutdown of the economy has brought us to where we are, but the resilience of our business and the resiliency of our consumers with the support of the government should lead to a recovery over the next year or two. Real estate markets in many localities have been severely disrupted by the COVID-19 pandemic. Between people wanting to move out of cities because of the concentration of people or some of the civil unrest that we have, the fact that people aren't able to pay rent for their businesses, which then goes to banks, which have to add to their loan loss reserves. Real estate has been something that, depending on where it is and what it is, has been impacted by COVID-19. So nothing escaped the crisis of COVID-19. Unemployment has begun to decline. but still has a long way to go in order to reach pre-crisis levels. And that may take a few years and will still need the help of the government. Swift and bold federal action was taken, and we hope another round will be passed at some point. As you know, for political reasons, there's been bickering back and forth on the next stimulus program. One group wants to have a $3 trillion infusion. The other group wants to have a $1 trillion infusion. Obviously, some compromise is required, and we think if it doesn't happen before the election, it'll happen immediately thereafter. In the future, though, we will have to deal with the deficit and potential inflationary impacts of these important and necessary actions. Our deficit right now is probably around $27 trillion cumulatively for the country. And this is something that will have to be dealt with in the future, whether through increased taxes or higher economic activity or printing some more money, but we will have to deal with it. But it's not a problem for now. The problem and issue now is getting the economy back, getting people to work, getting people to be able to pay their bills, and instilling confidence in both business and consumers. The American population is more divided than in recent history as we approach a major election. Obviously, we all read the papers and we all see cable channels and news, and we know that there are concerns amongst the public right now, whether it's racial inequality or it's a wealth gap. And this brings us to an election where the American population is severely divided. Hopefully, after the election, people will coalesce together, as Americans do when they go through a crisis. We believe being patient with a prudent asset allocation that is particularly overweighted to defensive strategies is the best course for most investors at this point. As Brian pointed out, we customize asset allocations to each of our clients. Every client is different, client goals are different, their stages in life are different, and we as a firm take it upon ourselves to make sure that we understand the needs and goals of each client and then try and carve or craft an asset allocation that fits them and fits them for the environment that we're in right now, which is obviously quite complex. Next slide, please. Some clients have said, should we just get out? Moving to 100% cash and trying to time the market is not our recommendation, and honestly has never been our recommendation. But make sure you have enough cash and high-quality short-term fixed income to sleep at night. We can't predict the volatility or the ups and downs of the market on a short-term basis. Over the long term, you all know we've done very well for our clients. So in an environment as complex and difficult as we're in right now, although we are cautiously optimistic that we are coming out of this, that there will be a vaccine, and that confidence is building, we would maintain enough cash and short-term fixed income so that you can sleep at night and not be subject to the volatility of the market. Concentrated portfolios of companies with strong fundamentals and managed with a focus on quality and secular growth trends that Brian described before, and or growing dividends should prove successful over the long term. It has for the 40 years that I've been doing this, and we believe as a firm it will continue to do that. And also very important, especially as we approach the end of the year, as we approach an election that could result in changes to the tax regime, both for individuals and for businesses, reviewing your overall wealth management plan with an eye towards understanding the tax, charitable, and estate planning options is a critical step for every high net worth investor. Oops, there we go again. And we can help you and your team of accountants and lawyers with selecting the right options for you. So, and actually we'll be writing a piece, I think will be coming out from our tax and financial department in the next few weeks about approaching estate planning coming to the end of the year, especially with potential changes in the future that may happen if there are changes in Congress. That concludes our summary, and I will turn it back to Karen to start the question and answer period. Thank you.
Thank you very much thank you, Bob, Ed, and Brian, for sharing all of this with our participants. We will now begin to answer questions. I know we're shortly approaching the top of the hour, so we'll get to as many as we can. Please send them in, and we will go from there. So I'm going to start with a question that is just, what is the biggest risk to the equity market rally? Phil Malikoff, do you maybe want to take that one?
Yeah, I'll take that. Thank you, Karen. So right now, I think there are two very timely risks out there that could threaten the market's rally. And Bob kind of alluded to this just a minute ago, but the first is a Democratic sweep of the Oval Office, Senate, and House. And while we don't pretend to be political forecasters, we do realize that this is a possible outcome. Joe Biden has stated that he wants to raise taxes on high-income earners, increase the capital gains tax rate, eliminate the step-up basis for inherited assets, significantly lower the federal estate tax exemption, and raise the corporate tax rate. So should Biden win election and the Democrats control both houses of Congress, these measures will, in some form, be enacted, which would have negative effects, at least in the short term, on the equity markets. Additionally, a contested presidential election lasting well past Election Day would certainly lead to volatility in financial markets. The next risk is a second wave of the COVID-19 virus and the ramifications this would have on the nation's already damaged economy. Major increase in the number of cases or fatalities this fall and winter, which could lead to reinstituting localized shelter-in-place restrictions, would potentially unravel many of the gains in employment, consumer confidence, and GDP that the country has experienced since the height of the pandemic. We certainly hope this is not the case, and we're hopeful that a widely distributed and accepted vaccine would go a long way towards reducing these concerns, and that would lead to a return of a more normal U.S. economy and confidence in our investment markets.
Great, thank you. Our next question comes from a client, and we sent in advance, so thank you for that. And it says, FLI has done well with investments in big tech, and now there's some concentration in certain of these companies. The client would like to know if FLI will be diversifying away from this heavy concentration and or provide some comments on their current comfort level with the valuations in this space.
Karen, I'll field that
yep.
one. Yeah.
Great.
Thank you. Certainly, these names have done well, and ironically, we've been rebalancing the portfolio, trimming some of the higher value names to add to more attractively valued companies. So there's been some rebalancing away from some of those names. It's interesting. Growth is difficult to maintain or come by, and these companies have demonstrated the ability to consistently grow their earnings, and they've certainly been rewarded from a price appreciation standpoint. And these companies remain well positioned to benefit from the adoption of long-term secular-driven growth trends that both Bob and Brian mentioned in the presentation. For example, Microsoft continues to benefit from the transformation of its business model and shift towards its Azure cloud computing business while transitioning its software offerings to a cloud subscription-based platform. So there's also other secular growth trends we're capitalizing with these names and feel like they have long growth trajectories that we want to capitalize on. So we will probably maintain a high concentration, whether it's investing in cloud adoption or e-commerce or digital payments or streaming. And I think on a case-by-case basis, look at the valuation and see if there are other better opportunities to rebalance the portfolio on a case-by-case basis.
Karen, can I hitchhike on that? It's Bob. It's a good question, And Ed gave a very good answer because we are investing in companies that have not 1 or 2 years of good growth to them, but many years because of secular growth trends. However, we also look through the lens of asset allocation, and we do what you'd call a barbell approach. Most of our clients, if not, I'd say large majority of them, have both growth orientation through a variety of our traditional strategies or one of our defensive strategies, but we also have the more value-oriented strategy, dividend growth. So when you look at both of them together, the concentration is less in the growth companies that were cited by the client, and it's a barbell approach so that you're getting diversification and that you will have exposure to both areas, the slower growing, higher dividend growing type companies, and then the Microsoft, Adobes, and other companies, Amazons, et cetera, that are growing more rapidly. So every client should think of it in those terms. Do we have proper diversification for them? And if we do, they can probably sleep better at night.
Great, thank you both. I think we're going to field one more question and then I will wrap us up. So banks and financials haven't performed well. The question is, what will it take for them to be market leaders?
Karen, it's Ralph. I'll take that. If you look at what happened, if you look at what happened in the banking industry in 2019, all of the banks performed pretty well, and they were moving along fairly well until the pandemic hit. The problem that the banking industry has right now is twofold. And if you look at the performance currently on the money center banks, you look at Citigroup down 42%, Bank of America, JP Morgan down about 28%, Wells Fargo down 52%. There are two specific problems that's occurring in the banking industry. One is obviously the pandemic. They have provided, or in the first and second quarters of this year, tremendous amount of reserves because they anticipate that in the third and fourth quarters of this year, they're going to have credit losses. And it's easy to see those credit losses when you see businesses, especially smaller businesses, being shut down and not being able to recover so quickly. The bigger problem is their interest margins. With interest rates being where they are and the flattening of the yield curve, and when you look at a 10-year treasury at 67 basis points and a 2-year treasury at 13 basis points and a 30-year treasury at 141, the banks can't make money with that kind of spread on the yield curve. And if you believe what Jerome Powell has said, he thinks he's going to keep interest rates lower for a lot longer, possibly even through 2023. Now we'll see what he has to say today in the Fed meeting. But so the banks have two issues that are really big issues. One will eventually correct itself, which is the pandemic. But the longer term issue is interest rates. And if anyone knows me for all the years that Bob and I have been doing this, I've only worried about two things in the equity market: interest rates and earnings. And if you have an earnings problem because you're putting away a lot of money for anticipated credit losses, and your interest rate spread is very thin, you're not going to have great performance. And the market has anticipated that, and that's why you see where they are. Going forward, depending on how bad the credit losses are in the third and fourth quarter, and depending when interest rates will start to rise and that yield curve will start to widen, then you could probably see some better performance for the banks. But my guess is that's a couple of quarters away.
Thanks, Ralph. So I think that's our last question that we'll squeeze in this morning. Obviously, if there are additional questions, please send them to us and we can answer you individually. On behalf of the entire FLI team, I want to thank everyone for joining us. We hope you found the session interesting and insightful. If you have any friends or colleagues who you think could benefit from joining a future event like this, please let us know and we can include them. As Ed mentioned earlier, on October 27th at 1:30 Eastern, we'll be hosting an online event with Daniel Clifton, the head of policy research with Strategic Securities. Daniel has been ranked a top Washington policy analyst in each of the past 11 years. Just 1 week ahead of the general election, this stands to be a really interesting session. We hope you can all make it and ask that you be on the lookout for an invitation that will be coming soon. For our clients on the line, I just want to remind you that our investment committee is always available to discuss your individual asset allocation. Please give us a call. We know that times like these carry some additional worry, and our team is here to discuss your individual situation, needs, and goals. We hope to be able to see you all in person again soon, but in the meantime, please know that we're completely available. We wish you continued good health and ask that you please do your part and continue to practice social distancing. We hope everybody has an excellent day.
Thank you, everybody.